Debt financing pros or advantages. Interest payments are tax deductible. So once again, taxes are going to have a huge impact on decision-making processes in many different areas, including the financing. When we compare the debt financing versus, say, equity financing, on the debt side of things, we have to repay the financing generally with the interest. Interest, in essence, being the rent on the purchasing power of the debt, because it's a general business expense. Because it's tax deductible, we're going to have a tax benefit from it. That's a huge plus on the debt side as opposed to the equity side when we think about financing options. The finance obligations are clearly specified. So once again, we can compare between the debt financing and the equity financing. On the debt side of things, we're going to have, say, if we issued the bonds for the debt financing, we know exactly what the face amount is. We know what's going to be paid at the maturity. We know what the interest rate is on it. What we do not know, of course, is the market conditions, because the market rates could change over time, but the actual terms of the debt will be well specified, and that's a great benefit, giving us a nice level or a known component. Whereas if you look at the equity side of things, financing with regards to equity, it's a little less clear in terms of the valuations as what's going on the equity financing. In a period of inflation, debt financing can lead to repayment using dollars of less purchasing power. So if you're in a period where you think inflation is going to be going up, and you finance with debt and you lock in the rate, meaning you don't have a floating rate, in a similar way, if you're an individual and you had debt related to financing the home and you locked in the 30-year kind of loan amount instead of having a floating rate, then if there's a period of inflation and you have to pay back the debt, then now you're paying it back with dollars that are now lesser in value, because of inflation has deteriorated the value of the dollar, but it didn't change the contract that was put in place because you had a fixed amount of interest that were determined instead of a floating amount. And that could be a beneficial thing, because when you pay back the debt, you will be paying it back in dollars that are worth less. They have less purchasing power. Now, obviously, the opposite could be the case as well, where the rates could go down, meaning the rate is higher and then possibly the market rate for whatever reason goes down. And in that case, you might want to think about seeing if you can refund or refinance, in essence, the debt in that situation in a similar way as you might do, again, with kind of like a mortgage on the home. The use of debt could possibly lower a company's cost of capital as well. So then you'd want to take into consideration your optimal structure between the financing of debt and equity, taking in your weighted average cost of capital, and think about the structure between the two of them. The debt cons or non-benefits of debts, the disadvantages, the interest and principal payment promises put in place by the debt contract need to be satisfied regardless of the company's economic conditions. So, of course, once the contract has been put in place, if there's unfavorable economic conditions that happen in the future, now you're locked into the contract still, and you're responsible for those obligations on the debt, obviously. So indenture agreements can place restrictions on the company. So if there is a problem going forward, then you could have restrictions with regard to the debt. So if you get in trouble with regards to your debt financing and with regards to the liquidity of the company, then the indenture agreements can place restrictions on what the company wants to do or needs to do in order to grow. So if used to excess, debt can lower the value of the outstanding common stock. So in other words, a certain amount of debt can be beneficial to leverage the company and help them to grow. But obviously, once you go past a certain level and take on an added amount of risk, then that could be reflected in the common stock price.